Hey, everybody, welcome back to today's Market Explained. It's a four-star media experience. Here's our podcast offering for today. I'm Brian Castle, your host, and welcome Mr. Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Glad to be here. Glad to talk a little bit about the markets.
Chris is my trusty co-host, and he's the director of development of FourStar, and he runs all the portfolios, and he runs development and so many other great things at the firm. And he's a dad with three young kids. And very successful. Thank you, Chris, for being here with us today.
Yeah, glad to be here. Like I said, glad to talk a little bit about what's going on and what's going on out there.
And I'm Brian Castle, your host. I'm the CEO and founder of FourStar Wealth Advisors. I'm an advisor to CEOs and insiders. I'm a trustee of the Boy Scout Foundation. I'm the chief dad to Quinn and Evan, and husband to the amazing Tripty. So if you like what we're hearing today, folks, please give us a 5 ranking on iTunes and punch that box and tell us that we're doing a good job. The higher rankings we get, the better it is. More people see it. But we're a top 1% podcast. We want to stay there and grow. So, Chris, why don't we walk into what is happening in the markets right now? You got a whole list of certain stats for us.
Yep. Yeah, so looking at a broad basis, so an asset allocation basis, we still have domestic equities leading the way in the number one position. And it's at 284 tally points and actually pulled back 3 tally points from the last podcast. So starting to see, very minor, but a little bit of deterioration there. Once again, very, very minor. But in number 2 is international equities, and it's at 277 tally points, and it's actually gained 5 points since the last podcast. So there is a closing of the gap there. And there is a potential that we could see international take over that number one leadership position. So certainly something to keep an eye on as that gap has kind of grown ever closer. But those are the 1, 2s. 3 is still commodities. That's at 231 tally points, -1 from the last podcast. Cash is still in 4th at 118, and that's equal. So unchanged from the last podcast. Currencies is in 5th at 94 tally points, unchanged from the last podcast. And fixed income is at 86, and that's -1 from the last podcast. So not a whole lot of change overall, but I do think it's interesting to keep an eye on domestic equities and particularly international equities. We could see a flip there. I still think we have a long ways to go if we're going to see domestic equities continue to weaken. There's a big gap between the 1, 2s and commodities, which is in 3rd. But certainly interesting if that trend continues, because we really haven't seen domestic equities deteriorate significantly. I don't think we really even saw much this year, maybe during the kind of tariff tantrum that we saw back in April. But even then, I don't think it was very significant. So certainly something to keep an eye on.
Yeah. Excellent.
Good. Sorry, go ahead, Brian.
And then you did some work on all the different groups and sectors, right? So what's changing?
Yeah. So, looking at the more broader market and what's going on there, interesting patterns. So the S&P 500 is pulled back significantly since our last podcast. It's only up 14.72%. So that's actually down from the last podcast was up 16.35%. So we're seeing a significant pullback in that more momentum-based index there. Whereas the equal weight, that's pulled back only slightly. So that's up 5.41% since the last podcast, and it's pulled back from 6.23%. So a little over 1% there. Whereas the pure or momentum-based S&P 500 there is down about 2%, so about double as much as the equal weight. And then kind of going underneath that now to sectors, a lot of change here. And this is where we're really starting to see some changes within the overall markets. So as far as top performing sectors year to date, we have a new number 1 sector, and that's utilities. So utilities year to date are up 21.16%. It's actually up 0.42% since the last podcast. So didn't really gain a lot, but it just kind of held its ground and moved up slightly. That overtook that position from information and technology, or tech, better called tech. That's up 18.11%. So that had a big pullback. That's down almost 8% from the last podcast. So a huge pullback from tech. from that number one position, but still holding that number two. The number three best performing sector is communications. That's up 16.43%. And that lost 3.61% from the last podcast. Number four is industrials. That's up 13.70%, and that lost 4.2%. And then what I think is really interesting, I kind of highlighted this. Healthcare is actually the fifth one. And if you go back probably maybe 3 months, healthcare was at one point the worst performing sector, one of the few that were negative. Now it's moved all the way into the fifth position, the fifth best performing sector. It's up 12.76%, and it's actually gained 4.2%, almost the opposite of industrials since the last podcast there. So interesting trends. We're really seeing healthcare gain ground. That was the best performing sector since the last podcast. Flipping to the other side, the worst performing sectors. The worst sector so far year to date is consumer discretionary, and it has actually gone negative year to date now. It's negative 0.71%, and it's down 6.97% year to date, or since the last podcast. Sorry. So that's a big pullback, not as big as tech, but the second worst pullback since the last podcast. Consumer staples is the second worst performer. That's up, but only up 0.8%. And that did actually gain slightly. It was actually up 0.37% since the last podcast, but obviously still just kind of steady and flat for the most part. Real estate is the third worst performer. That's up 3.27% year to date, and that lost about 0.5% since the last podcast. Materials is up 4.50. That's the fourth worst performer, and that was up, or that pulled back about a little over 0.5% since the last podcast. And then last, the last one I'll cover is energy, which is the fifth worst performer. And that was up 6.89%, and this one actually gained 1.89% since the last podcast. So that was the second best performing from the podcast to podcast sector wise. So a lot of changes here. Obviously, we're seeing a heavy pullback within tech, communications, industrials, and consumer discretionary. So a lot of these more aggressive, if you will, asset classes, more volatile. And we're seeing utilities obviously continue to be that steady. But then healthcare was the big surprise there. And then energy starting to see a little bit of a rebound.
Brian Kasal, I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Yeah. So a lot of changes. So the consumer has gone negative, Chris. What do you think that says?
Yeah, I mean, I think with consumer discretionary, and I have a kind of a note of this for later in the podcast, but we're starting to see some slowing as far as spending out there. So I think with potential of the labor market slowing down, things like that, I think we're starting to see that saturation of inflation with consumers as well. So I'm concerned there that we could start to see an actual significant slowdown as far as spending. And obviously consumer discretionary is where that's really impacted first, discretionary purchases.
I guess that makes sense. And with utilities still now back in the lead, they were in the lead before, now they're back in the lead as information technology and communication services is kind of collapsing here. That's still kind of the energy side of the AI trend, right?
Yeah, no, I mean, 100%. I mean, I think the utilities, they usually do better during volatile markets. They pay very good dividends. They tend to just be a little bit more of a less volatile within the, obviously, equities class, less volatile. You factor that in, plus There's a big imbalance as far as supply and demand for energy right now. We look at AI, we look at a lot of these revolutions, if you will, that we're seeing in tech, and that requires a lot of power, a tremendous amount of power. And right now on the existing grid, we just do not have that supply of power, that capacity there. So that's why we've seen utilities such a strong mover as far as sectors. Usually it's really more around that 10%, kind of a steady mover. It's going to be more of a defensive asset class, but it's certainly obviously flipped the script a little bit this year. And
Mhm.
just because of that, that anomaly where we have such a big gap between supply and demand with the energy needs there. We've seen it with nuclear. We're seeing that highlighted a lot. We talked about it before on this podcast, how AI firms are going to 3 Mile Island. They're going to these nuclear power plants and they're trying to sign agreements. So it is definitely a heavy need out there, and
Mhm.
it's interesting though because we really haven't seen anything like that.
Yeah.
So
No, it is interesting. And so whenever we have like a market sloppiness period or correction period, you see things like this happening where sectors that were way in the tank start to rally, and things that were hot are not anymore. And I've got the market indices here, Chris, with the Nasdaq was up as high as 22 and change. Now it's only up about 16 and change. So it got really sharply whacked. S&P 500 was up 16 at our last show. That's up only 12, also affected by those tech names. But even the small caps, Chris, the Russell 2000 names were up 10.66%. And that was the story of the summer, is that small caps had a big rally. Well, now it's only up 4%. It's down over 7% since we last met. So that was, those things tend to get whacked pretty quickly. The Russell 1000 value dividend stocks was up 10.4. Now it's up only 8.2. So it did get hurt, but not as badly. And then the Dow Jones, which is also similar, but not quite just pure dividend stocks, 11.36 previously. Now it's up only 8.62. So the dividend stocks are getting hit less. The volatile small caps are getting sharply hit, but it's really all about the technology names that are getting whacked right now, right?
yeah, I mean, I think what's going on currently, and especially the last couple of weeks, really, we've seen a heavy injection of kind of volatility within the markets, and a lot of it's looking at these lofty tech equity valuations. They're bid up on kind of AI and the promise of this, and I think there's concern. Are things kind of overheated a little bit?
Mhm.
I think you have kind of that facet of it, and then underneath that, you also have the facet of the Federal Reserve. So, we talked about that, the government shutdown, which was delaying economic data. Now you're kind of starting to get, on top of the high valuations, on top of all that, you're starting to get some economic data that's going to trickle out a little later this week. And traders are factoring in less likelihood that the Fed lowers rates in December. And so that has a significant impact, especially when you're looking at these large companies who are looking to do very large deals. And we're looking at 30 billion. I know there was a deal that was just announced, I believe, today. So the financing and all these things for that it gets more expensive for these companies. So when you have these higher expenses, you have to have a higher return.
Mhm.
And so it really puts a lot of emphasis on earnings. And I know one of the big things this week really it's tomorrow, so we're taping this on a Tuesday. So Wednesday, November 19th, Nvidia reports earnings. And a lot of people are looking at that as a kind of a litmus test as to whether this AI rally is going to continue or it's starting to burn out.
Right.
So we kind of have these tests that are really being out there to kind of showcase it. And then, like I said, we've had this delay in economic data, so things seem to kind of heat up a little bit more, interestingly enough, when we had that delay. But are we going to get this data comes out now and it's not as solid, as people were expecting, or more solid than people are expecting? And what is that impact is that going to have on the Federal Reserve and their expectations on lowering interest rates? We'll have to see. Definitely a very volatile time. A lot's hinged on earnings and kind of what the Federal Reserve is going to do, which is it's a tough spot to be in.
Well, there's no doubt that there's going to be enormous amounts of money spent on artificial intelligence and technology over the next 5 years, let's say. But a lot of that's already been announced. And so the investments will be made over the next few years, and the benefits that will come in over the next couple of years. But the market's been reacting as if it's like almost like a 10-year move. And so maybe the market's overreacted. So the correction we're seeing is the realization that, okay, we've come to the end of the positive announcements that we can make for a period of time. The investments will happen, but maybe the market overheated itself to getting excited with all that information. And now those tech names are going to sell off. You know, that's a possible scenario, Chris. We came into this sloppy period where the S&P was trading at its all-time record high multiple that it traded in 1999 at 23 times earnings. But if you do an equal weighted measure of all the stocks in that index, it's still only about 17 times, including those AI, Mag 7, whatever you want to call them. Those are the names, the hot tech names. And so is the market really overpriced here? Overall, in general, it's really not. But if we do have a big sell-off like this, do you think those stocks that are not overpriced are going to stay up and just that group is going to go down? Usually it doesn't happen that way. Usually everything goes down a little bit. It's just certain things go down less. The big techs that are on a big bubble, the bubble will get popped. Those will get sharply whacked. We've been taking some profits for a while. We're hearing discussions that companies that are buying gear in AI are getting actually financed by the company that's selling it. Those aren't good trends, and Nvidia and others. So when we hear stuff like that, then we know that, maybe they're pushing so hard to get growth that maybe we're coming to the end of that growth cycle, however great it is. And it is great, and it is going to affect the economy a lot over the next 5 years. But maybe like all the market excitement about it could be ending. At least that's the way it looks like the last couple of days, Chris. So we'll see if this trend continues, right?
Yeah, I mean, 100%. I think one of the things that's been really tough with this market cycle or this trend has been a lot of these investments have been coming from private companies, private equity. Most recent one, Anthropic, which is kind of an AI research and startup, they committed 30 billion to Microsoft Azure for its Claude AI models. So, it's we're seeing this injection of cash, that 30 billion, it's a lot of money, and that's going to move the needle. But we don't know what Anthropic's balance sheet looks like and how do they plan on kind of monetizing this. So we have kind of this gray zone because of the private equity market. So it's always really tough when we have, it's not a public company, injecting cash into another public company. Then you can kind of track the cash flows. You can't really track it as much. So there's also speculation, what's the composition of these deals and where is that coming from? To your point, Brian, are they getting financed by the, same people that are selling it? You get wonky situations like that.
Yeah. Well, it's interesting, and obviously, the economy has been slowing. So usually we don't see a big rally like we had up until 2 weeks ago, in a slowing economy. But maybe the economy isn't going to slow that badly. Chris, what do you have on the economy? Let's dig into that.
Yeah, just a couple items. Like I said before, we're going to start to get a trickle this week, if you will, of more economic data that was kind of backlogged. The first one that did come out, and I think we're supposed to get another one in a couple days. But the
Yeah.
U.S. factory orders for August increased 1.4%. That came after a 1.3% decline in factory orders in July. That was about in line with economists' expectations, so nothing, I'd say too crazy. Didn't over promise or under promise necessarily there. So factory orders were pretty much in line. And then the University of Michigan consumer sentiment for November, this is kind of their preliminary reading, came in at 50.3, which was below the expectations of 53.2. So consumer sentiment continues to kind of wane from that as we're entering kind of the end of 2025 here. So like I said, those are the only big ones. I know we have a big jobs report number as we start to get some of this backlog data out. Probably the coming weeks we'll have almost a big catch up as far as the data and everything, but still pretty light on the economic data as of right now.
Okay, so yeah, but we're getting any economic data because of the government shutdown. So we'll see But we are getting leakages of different bits of information. So we'll see how things play out. We are seeing some interesting economic data points come out from different groups, like about home building. One interesting one that we got was the average age now of the first-time home buyer is 40 years old. I bought my first home at 26 in 1986. It was up from 33, age 33, first-time home buyer in 2021. So it's up dramatically. A lot of that just has to do with the price of homes. And we're well over $400,000 for the average new home. Obviously less. I was in Michigan City, Indiana. There's some pretty cheap homes there. So there's not too many opportunities for new home buyers. A lot of that just has to do with the fact that we haven't built enough home units in this country, whether it be condos or individual homes, or townhomes or whatever. And so they're way behind on that. But then because interest rates were kind of funky for a while there, the real estate market slowed down. So the home builders couldn't really build because they couldn't really sell. People weren't buying. But now rates are going down a little bit. Maybe they'll start to buy again. That could help the real estate market quite a bit. And Trump is trying to keep inflation down. He's going to be getting a new Fed chief. The current Fed chief is kind of a lame duck, and he wants to get rates lower. But we have to keep inflation from exploding. That's the big risk here. So we'll see what happens under the new Fed. But everyone's expecting, Chris, at least a couple more rate decline moves here in the next year, don't you think?
Yeah, I mean, 100%. And I do think that is going to happen no matter what. I do think we will see those. Obviously, the focal point right now is on December. And I do think that's probably up for consideration, especially with the lag in economic data, things like that. So it'll be interesting whether they decide to cut or not. But
Mhm.
certainly that the trend is them cutting. So,
Mhm.
most likely in the next year, we will see, at least a couple more rate cuts. One thing that I think is interesting from the home perspective, Home Depot reported earnings, I believe it was yesterday, and they had actually a big drop. They missed on their earnings forecast for the recent quarter, and then they forecasted a larger drop in their full year profit. And so, what they kind of quoted a lot of their executives is that stagnating housing market you were talking about,
Mhm.
Brian, where you just don't have as many people purchasing or looking to sell their homes, quite frankly, because the high interest rate market still. And so you don't get those turnovers of refrigerators and large ticket items, things like that. You don't get people fixing up their homes as much. So interesting that we're seeing that trend play out into not just the housing market, but also the retail market in certain areas. So, really interesting. It's going to be an interesting fourth quarter. I think, like I know I said, as I said, you have these earnings are really, I think, being spotlighted by the traders and the market right now. I think it'll be a good litmus test to see, are we
Mhm.
going to be moving upwards, or like you said, Brian, are we going to see a big pullback?
Yeah. Well, and it could, like I said, it could easily be that we have a slowdown in the economy, but it's not going to be terrible. America is still the leading country in the world, and tons of money is coming here. People want to be here. As we've had this influx of immigrants, if you can come to America, why wouldn't you? And the stories we hear about life in other countries. I met a lady from China who became a big entrepreneur in America, and the stories are just horrific about some of these other countries. So it's really a shame. America is still the beacon of freedom and liberty in the world, opportunity and capitalism, where people can get ahead and make money, build a family, build a financial life, and it's really exciting. So we don't think that there's any fundamental issues right now in the economy to say we're going to have a 2008 like or depression like big downturn, but we could have a downturn in the economy. Maybe it could go negative. I don't think it's going to go seriously negative though, and we're not going to have -6% GDP quarters like we had in 2009 and things like that. So that could be what the market's saying. The market's saying possibly, hey, it's a little sloppy here, we're going to maybe pop the AI bubble, but things are cheap and maybe the markets will be good. So we're generally positive on the markets, with corrections, Chris, happening at any given time, just randomly. And that's maybe what we're seeing now.
Yeah, I mean, market cycles, they're a cycle, they're cyclical, and certainly corrections are healthy. Obviously, if the market just goes up, you get hyperinflation, you get things like that. We need the market to constrict a little bit. Because if everyone just has tons and tons of money and keeps throwing around money, we get kind of what we saw almost with the housing prices, right? Everything just keeps going up and up and up and up. We have
Mhm.
to see that restriction, that demand kind of contract a
Mhm.
little bit, for even vacations, for plane tickets, for all that, because that's going to rein in some of these prices. That's going to put pressure, market pressure on these companies to lower prices, to be more competitive, to try to gain. So, there is that aspect to it. It's not pleasant, obviously, but it is a healthy thing for the market to do. So, I think the best case scenario, maybe we do see a little bit of a recession here, maybe two, with some
Mhm.
just very small slowing cycles here. And that helps kind of, I think retract things a little bit and kind of get things back into neutral, if you will,
Yeah.
so we can have that next expansion cycle.
Well, Chris, and just moving on to the kind of talking more about the economy a little bit, and then I'd like to say something like a tale of three cities, and it's about our three largest cities in America. Usually, when economic times get a little bit sloppy, there's proposals that come through to that are socialistic, right? Where we want to give free money away and subsidize everybody and take care of everybody. And it's usually at the wrong time, right? When the economy is not doing well, all of a sudden there's not as much tax money, but they want to give more things to people. So just in Los Angeles this week, they announced the 4% cap on rent increases on stable properties, right? So if there's a tightness in the market and rent increases should go higher than 4%, they're going to say, no way, no more than 4%. And that's fine, right? But whenever you put caps on things like that, you've got real issues because then that distorts the market. Then there develops a black market. Then the prices go up anyway, and they're just hiding it. Whenever you restrict the free market, then you get other anomalies and other distortions, and that's kind of socialistic type talk. We also saw in the recent election an election of an avowed socialist Marxist mayor, Mamdani. And of course, his ideas were tax the rich. There's a big tax the rich rally in New York now, just yesterday. And then the government food stores, which is a bad idea. Government can't run anything right generally. And they have the government running the food stores in a very, very tight 1% profit margin business. They're going to lose money, and the taxpayers are going to pay for that. So if you say government food stores, it's taxpayer funded food, is what it is essentially. And so it's going to be a bad scene. And then even in our city, home city of Chicago, the mayor just put through a budget yesterday for a 23% head tax and a whole bunch of extra corporate taxes. And so those are also very socialist ideas. So we do have kind of a mini socialist trend going on in America. And that's just when economic times are bad. A lot of the groups get prominence. Ironically, we're seeing the exact opposite in Europe, where we're seeing conservative leadership, capitalistic type leadership taking over those countries. So we'll see how far this goes. None of those ideas have ever worked. If they ever worked, they would continue to work, but they always seem to fail on the cutting room floor when everything falls apart. And so we'll see if the L.A., New York, Chicago tale of three cities continues and it becomes a problem for America, Chris. We'll see.
Yeah, I mean, 100%. I think a lot of it's it's I don't want to say reasonable, but it's off the growing frustration. I think that a lot of millennials, a lot of Gen Z, even Gen X people have, that things are unaffordable to them. They can't have that life that their parents had, things like that. Because as you alluded to, Brian, I mean, you bought a house at 26. Now someone can't buy a house at 40. That's a huge loss of equity that you've gained in that. So I think that that's why you're seeing a lot of this. There is, when you get this kind of this movement here, it causes this, right? When you get the
Yeah.
economic conditions like this, it's kind of right for
Yeah.
someone wants something better. And that's
Yeah.
kind of why we're seeing it more now.
Well, so here's the markets and here's the economy, and markets are getting a little sloppy. So the question we always answer for everybody is, what are we doing about it? FourStar has a program we call the Protection Plan that only comes into being when the markets are rough. 85% of the time, the markets are going up in normal fashion. Little corrections here and there, but no serious issues. Right now, we're seeing rather sloppy markets. So in the S&P related, the growth oriented parts of the market, we're already seeing is a downturn. So out of 4 different signals that would take us from fully invested all the way to maximum cash. And in the portfolios we run, we're already at position number 1. And only about half the time that we go to position 1 and start protection do we go all the way to position 4. We'll go down to 1, 2, or 3 and then turn back up. But then about half the time we do go to position 4. And Chris, as you remember, we did that back just before Trump's Liberation Day this year. We've done it only 8 times in 31 years. The only other year we've done it twice at all and gone to maximum protection was in 2022. That was the worst investing year of our careers that I can remember. We don't hope this doesn't turn into that as well. But right now we have started our protection plan, but the dividend stocks have not really sold off. The small caps have, and the international stocks are holding up pretty well also. So it's really more been an American phenomena right now with our tech being popped. And that's where we are right now. Chris, I think that's all we have for today. Do you have any other thoughts for us?
No, I think that about covers it coming into the middle of November.
Okay, great. Folks, we've got some great articles on the Leadership Matrix blog on FourStarWealth.com on our blog site. So have a look at that. And we'll have some other actually very interesting podcast interviews. So keep checking the FourStarWealth.com site where we have the Leadership Matrix blog and some other blogs in there as well. And we'll have some opportunities there to see some interesting interviews that we do, as well as some articles that we think are important for investors to read. So thanks everybody for being with us. And Chris, I guess that's it for us. Over and out.
Yep, sounds good. Over and out.
Thanks everybody. Bye for now. Back with a new episode soon. Bye-bye now.